in purchase mortgage applications, reflecting the fact that mortgage rates had come down because there was some concern that the coronavirus would have modest impacts, slowing global growth, but that they would still be fairly well contained, and the economy would continue to hum. The U.S. economy will continue to hum along. With that came a spike amid lower rates and still strong labor market. You saw a spike in purchase applications. At the same time, you also saw an increase in refis. Again, this unexpected decline in mortgage rates increased applications to refi. But then after COVID-19, the contours of COVID-19 really became truly appreciated. What we began to see in terms of applications was a collapse in purchase applications to levels that were last seen in 2014 and 2015, and a real surge in refinance applications, more than doubling to levels that even exceeded where they were in 2012. Refinance applications have receded a little bit in recent weeks, but they still do remain quite elevated. And if you can move to the third slide. And so the result is, the result here, again, returning to the slide, the result is that expectations for the mortgage market have flipped. And I think it's important to point out that two things. First, there's not just been a 180-degree turn in terms of what people think how the mortgage market is going to perform over 2020, but that it happened in such a very short period of time. Most forecasters typically will stand by their beginning of year forecast for at least 6 months. And so the fact that this has been just a significant reversal in a short period of time speaks to just how impactful COVID-19 has been for the broad contours of the mortgage market. But, and I think the last thing I'll say here is that I think it's also important to keep in mind that, COVID-19's impact goes well beyond simply reversing expectations for refinancings or purchase originations. Because it's really infected nearly every part of the mortgage market structure, from lending standards in the primary market to investor liquidity in the secondary market, particularly in the non-agency sector, as well as the health of independent mortgage banks, which account for the majority of new agency origination. I think the good thing is that the federal policy response has been swift, probably taking into account the lessons learned during the financial crisis, and that includes congressional action through the CARES Act and the actions taken by the Federal Reserve. But I'll just wrap up with, I think that further action is needed to help stabilize the market. One idea that I think, one area where action is needed is certainly a financing facility for non-agency securities. But there are definitely others, and I think that they'll be spoken to as we continue to go through this call. Thank you very much, Lori.
Thank you. I'm going to actually talk about the impact of the Fed's actions and lender profitability and some lender profitability issues. So this actually shows you Fed absorption of agency gross issuance. And I want to point out that Federal Reserve intervention was the highest it has ever been in any single month. If you look all the way to the right side of this slide, you can see that the Fed bought $292 billion of mortgages in the month of March. This is higher than any single month of purchases ever, and it's higher than any single month of gross issuance ever. And in fact, it's 178% of March issuance. So just to sort of give you an order of magnitude on what the Fed has done. And now what I'd like to do is actually motivate that. So next slide, please. This shows you what's the spread between the 30-year Fannie Mae secondary market minus the 10-year Treasury, and you can see, and this shows the spread since 2004, and you can see while we're not at levels that we reached in the Great Financial Crisis in 2007, 2008, we're certainly at the most elevated levels. We were at the most elevated levels since then. Now let's look at it in more detail this year. Next slide, please. This shows you the spread for this year only. And you can see that the spread between Fannie Mae 30-year current coupon mortgage and the 10-year Treasury had been around 80 basis points in the January-February period. It went up to 160 basis points just prior to on March 12th. The Fed came on March 12th. The Fed came in on that Sunday night and said, we're going to buy up to 200 billion of mortgages. Spreads went down for a couple of days, and then the market said, wait a second, this isn't going to be nearly enough. At that point, the Fed came in. At that point, spreads started to widen, and in fact, widened to wider than they were before, at which point the Fed came in and said, we're going to do whatever it takes to stabilize the market. At that point, spreads began to contract, and while they've been very volatile ever since, that was enough to provide confidence that it was business as usual in the agency MBS market, or at least as close to business as usual as you could get. I mean, we're going to talk a little bit more about the financing issues and the credit box a little bit later in this call, but certainly the spreads themselves stabilized, not without repercussions for the spec pool market and some rather large hedging losses, but spreads stabilized. Having said that, next slide, please. These, because originators have so much of a backlog in terms of refinancing supply, this is not getting through to the primary market. This shows you if we've got the same two pictures here. On the left-hand side of the page, we've got the primary versus secondary rate, and the secondary rate minus the 10-year Treasury rate since 2004. And on the right-hand side of the page, we show it since the beginning of the year. You'll notice that that obviously the primary rate minus the second, if you look at the primary rate minus the secondary rate, that is the difference between the blue line and the orange line, you can see it's much wider than it's historically been. By contrast, the secondary rate minus the 10-year Treasury rate, that is the area under the orange line, is not too much wider than it has historically been. That is, from 2004 on, the average rate between the secondary between the perfect current coupon Fannie Mae and the 10-year Treasury has averaged 93 basis points. The last spread, which was last Thursday, was about 106 basis points. And the difference between the primary and secondary rate has averaged 80 basis points. The last spread was 163 basis points, more than double the historical average. So what this says is that, you know, when faced with heavy refi supply and very full pipelines, no originator has any incentive to lower rates. But over time, as they work through these pipelines, you could actually see much lower primary rates consistent with Treasury and secondary market mortgage rates. If you go to the next page, the result of the very wide primary secondary spread is that originator profitability is actually the highest it's been since the last huge refi wave in 2012, 2013. That is, this is the spread, this is the Fed's measure of originator profitability and unmeasured costs. And it's a very crude measure. What it does is it takes into account what it takes into account is this, you know, sort of how much the mortgage originator makes, the difference between the primary and the secondary rate, plus takes into account the value of the servicing. And you can see that, you know, in heavy refi waves, what you end up with is origination is more profitable. Now, what this does not take into account was very significant this time around, as we'll talk about a little bit later, is the rather large costs of advancing to the servicers. But just to point out that on this measure, profitability does look high solely because of the very wide spread between primary and secondary rates. Obviously, the value of mortgage servicing rights has come down considerably in the rally, as you would expect. So with that, let me turn it over to Karan Kool, who's going to talk about GSC Risk Management.
Thank you, Lori. So let's switch gears. So Lori just talked about the agency MBS market primarily, and that's a market where, obviously, as Lori mentioned, we've seen huge intervention by the Fed. At the other end of the spectrum is the GSE credit risk transfer market, where we haven't seen any sort of intervention from the government. So as you all know, Fannie Mae and Freddie Mac have been transferring credit risk to the capital markets since 2013 through their CAS and STACR risk transfer securities, CAS in case of Fannie Mae and STACR securities in the case of Freddie Mac. These securities were put in place after the Great Recession, and the goal was pretty simple. It was to allow Fannie and Freddie to lay off mortgage credit risk to private sector, thereby reducing risk to the GSEs themselves, and of course, by extension, to the taxpayers. And the CAS STACR structure, just for background, works as follows. Investors basically pay the GSEs upfront cash to buy these bonds in exchange for a return. And the return they seek is expressed as in terms of a spread over the 1-month LIBOR rate, which is what you see in these graphs here. And the spread varies through time depending upon investors' expectations about borrower default, economy, house prices, and ultimately the amount of credit losses they expect these securities to bear over time. In general, the spread widens as their default expectations and loss expectations increase, and vice versa. So again, this chart shows the spreads for 4 vintage indices of credit risk transfer securities: the 2015 index, 2016, the 2017 mezzanine, and 2018 mezzanine index. And by the way, this data is provided by Vista Data Services. And it shows the spreads on these 4 vintages since the beginning of 2019, so just over 16 months. And what's interesting here, to note is the far right portion of this graph, where you see this extraordinary spike in spreads last month in March as the adverse economic consequences of COVID-19 became clear. Initially, there was a lot of forced selling by REITs and other market participants in response to margin calls, as well as growing uncertainty about how many of these loans will default and what the losses would be. Just again, to give you an idea, pre-COVID, these spreads were generally around the 200 basis point mark, about the 1-month LIBOR. At its peak, they went to about 1,800 basis points, which is just unheard of. Now, since then, spreads have come back considerably as market volatility has moderated, but it's still important to note that they're really very, very high compared to where they used to be. And we're about in the 600 to 700 basis points range, which is about 3 times the 200 or so they used to be. So still a lot of investor angst and anxiety about the direction of the economy in the near future, job losses, default rates, house prices, and so on and so forth. There's also a bigger point here that's worth noting, which is that amidst all of this uncertainty, what this chart really shows is that the GSE risk transfer market is actually working exactly as expected. Any credit losses on these securities that are absorbed by these investors are losses that the GSEs will not have to incur. And by extension, the taxpayers won't have to be on the hook for. That's a huge improvement to our housing finance system compared to the system we had before the Great Recession, when GSEs used to take on most of this credit risk. Today, they're laying the vast majority of their credit risk on the new book of business to the private sector through a combination of either these credit risk transfer securities, private mortgage insurance, as well as reinsurance transactions. The last point I'll make on this is, having these multiple risk transfer securities is also good because it gives GSEs flexibility in turbulent times like this. Attempting to issue new CAS STACR securities in today's environment would pretty much guarantee that no investor would buy them security because of all the uncertainty out there. In fact, that's probably the reason why the GSEs have not issued any new securities since early March. So it wouldn't come as a surprise to us that the GSEs in the near future will lay off either less credit risk or no credit risk at all through these gas and stagger deals, and we would expect them to use some of the other structures more until this market stabilizes. So obviously, we'll keep an eye on this and keep following this issue. Let me stop there, and I think I'm going to hand it off to Sarah Strochak.
Actually, Ron, let me actually make one more point. We were actually missing one slide that we'll include in the packet that we send out after this, and that is that I think there's some interesting things to point out about credit in the jumbo market and the non-QM market. So the jumbo market, so credit, so Sarah's going to talk about sort of what the potential is for credit for mortgage credit going forward. The MBA mortgage credit availability index for March, which is based on originator guidelines, showed that credit had tightened 16% to the lowest level since 2015. The government index was down 6.6%. The conventional index 24.2%. That conventional index is broken into two pieces. Jumbos were down 37%, and the conforming index was down 2.7%. So basically, the jumbo credit box in March had already tightened a lot. That is, the parts of the market the Fed had supported, the government loans plus GSE loans, credit was tightening, but it was tightening, but not astronomically. Although it will be much tighter going forward. The jumbo market had already tightened astronomically. Meanwhile, the non-qualified mortgage market was totally shut down. Non-QM loans are loans to borrowers with one or more of the following characteristics: self-employed, rely on non-traditional documentation of income such as bank statements, and have higher debt-to-income ratios or lower credit scores. The major lenders in this space aren't making loans at all. Angel Oak is shut down, Citadel is shut down, JMAC is shut down, Nations Direct Mortgage is shut down. The obvious solution to this is to open TALF, the Federal Reserve's term asset-backed loan facility, to AAA MBS. Currently, asset-backed securities, CMBS, commercial mortgage-backed securities, and CLOs, the highest credit quality, are covered under TALF, but AAA MBS is not. So with that, let me turn it over to Sarah Strochak.
Thanks, Lori. So every quarter we release our Housing Credit Availability Index, known as the Hakai, which measures the share of owner-occupied purchase loans that are likely to default. We recently released the numbers for the fourth quarter of 2019, which showed that credit availability in the whole market, which consists of the GSE, government, and private label portfolio channels, remained constant at the end of the year at 5.3%. However, we know that there's a big lag here, so this number doesn't reflect any of the recent changes that we've seen. And in the wake of all the turbulence, we've done some additional analysis to estimate what credit tightening might look like in today's market. So can we go to the next slide? So we know that many lenders are tightening their lending standards, and this varies a lot by the lender, but just some examples, Wells Fargo and US Bank have both put in place a minimum credit score of 680, Flagstar has done a minimum credit score of 640, and there's lots more examples, but so far JPMC has instituted the strictest overlays on agency lending, so we use their criteria to estimate the effect of this. Next slide. So these are the following criteria that we've used for this analysis. No investment loans, no cash out refis. For borrower characteristics, they're requiring a FICO score of 700 or above, an LTV of 80 or below, and a DTI of 43 or below. So some affordable lending programs are exempt. We don't have a way to measure this exactly, but we use loans with an LTV of 97 or above as a proxy for these programs. And they've also instituted heightened reserve requirements, but we weren't able to quantify this in our data. Next slide. So the first exercise that we did is just using all 2019 GSE lending, how many loans would fail these criteria. And we can see here that the numbers are pretty high. So of the 2.1 million purchase loans originated last year, only 1.4 million fail at least one of these criteria. And for refinance loans, we see an even higher share failing, mostly due to the cash out refinance standard in place. Could we go to the next slide? So in total, 64.17% of purchase loans fail at least one of the criteria, and this makes up about $356 billion in volume. Next slide. So we wanted to look too on the effect of this on first-time home buyers, and we can see here that exempting the affordable lending programs makes a big difference. So if we do not exempt loans with an LTV of 97 or above, nearly 80% of loans to first-time home buyers wouldn't have been made under these standards. With the exemption, it levels the playing field a little more between first-time and repeat home buyers, and we can see that the difference in loans that fail at least one criteria is a lot smaller, and there's a lot fewer loans for first-time home buyers that are failing based on the LTV criteria. Next slide. So the second exercise that we did is what do these standards actually do to our Hakai? And so here you'll see this is the Hakai for the GSE channel. And default risk has been hovering around 3%, which is a lot lower than it was in 2001, 2003, which is the time span that we kind of consider reasonable lending standards before the crisis. Next slide. So on this slide, you can see that these overlays would significantly cut risk in the GSE channel. So our 2001-2002 average was 5.5%. The 2019 average, as it was 2.9%. But if these standards had been in place for 2019 lending, we would have seen risks much, much lower at just 1.03%. And now I think I'm going to pass it to Cheryl for questions. Oh, no, to Dave.
Yeah. So yes, then, and thank you very much, Dave, for participating today. And we're going to turn it over to you.
So I think I'm just going to talk to some of the data that's in the PDF version of the Chartbook, and and this is mostly talking about the non-bank challenge. And I'd just like to put out a perspective as to why there's so much of this angst. Is this the PDF itself?
Yes.
Oh, good. So could you try to go to, let's start with page 9. I just want to paint a picture here. And it's numbered, the number page 9 at the bottom. Yeah. There we are. Go down the bottom there. So you told the story already, but one of the things about forbearance advances is it takes a lot of liquidity, right? And we've seen different estimates about what the take-up might be. Director Calabria in media interviews suggested it would be in the low single digits. We're already kind of above that, and others are expecting us to get into double digits here shortly in terms of forbearance advances. And I'll explain this refi slide and why it's important. The question is, where does all that money come from? Because it was unforeseen, unexpected, and what was unique about the CARES Act when it was passed is that it did two things. It opened it up to anyone who simply wanted to opt in for a forbearance program where they would defer their payments to sometime down the road. And then two, it's a 6-month program with a 6-month optional extension. When I was in the administration, the forbearance programs we had were not open to all. They had friction in them. You had to prove hardship. So if you could qualify, you wouldn't get it. Granted, that creates a lot of problems for servicers. And it's great to play armchair quarterback and look back to how you might have structured it in such a way to give a trial period and a qualification test. But nevertheless, this is where we're at. but it was also only 4 months. And on top of it, the loans were considered delinquent on first payment forbearance. So if you go back to forbearance that was done during the Great Recession, if you went into forbearance, it was reported as 30 days late and in forbearance and so on and so forth. And obviously when you reach the 120-day mark, the loans were pulled out of pools, and you could begin to talk about reimbursement to the servicer. So it was shorter. It had friction in terms of credit impairment, as well as proof of hardship. So this is very different. It's going to be much bigger. It's much longer, and the liquidity needs, therefore, are going to be greater. One additional element is under the CARES Act, it explicitly says that loans that opt in for forbearance are to be considered current, meaning reported as on time. So no delinquencies associated with these mortgages. And that has created a lot of friction between industry and the GSEs in particular. And so what is happening in a general sense is for Ginnie Mae programs, using the FHA program, for example, Ginnie did two things. One, they set up a liquidity facility, PTAP, that could be tapped into without a servicer having to be in technical default. So it opened up a potential liquidity opportunity for those who are servicing Ginnie Mae loans. But they also have a predetermined structure for how the forbearance process is going to work. The borrower goes through the forbearance period. At the end, they start paying their mortgage payment again. The principal is then tacked on to the principal and interest advances are tacked on, and frankly, the taxes and insurance are tacked on to the back of the loan in terms of the secretary's lien. And you submit a partial claim to FHA as a servicer. FHA reimburses you for those advances. That's a preset structure that at least gives relief for liquidity if needed, not perfect, but better, and also gives a process by which you get redeemed, and it explains to the consumer what's going to happen with that, the P&I advances that were made, and then the consumer has the option of either paying it off when the loan gets refinanced, or when they sell the home, and they can pay it off over time for that matter. So what are large servicers doing? One other thing is that with these big refinance volumes that we're seeing right now, which are huge, and most non-bank servicers I'm hearing are doing, even current application volume is north of 60% refi. That's going to create a lot of payoff on servicer balance sheets. As you know, when the loan pays off, you don't have to remit to the investor typically to the following month. And that gives you float money to use as advances. It's a bit of a shell game, but that's how some can get by as long as this churn keeps happening. And the Fed has helped that happen to some degree. So that eases the burden. As you all know, the FHFA announced a 4-month limitation to advances that will have to be made by the servicer. What they didn't communicate clearly is whether they're going to pull those loans out of pools or keep them in because they're performing until the forbearance period ends. And so to me, it's not quite clear as to when the servicers are ultimately going to get their advances back. So it could still be a lot of liquidity sticking out there that these servicers have been stuck with, thrust upon them, simply due to the way the ledge text was written and the GSEs providing some flexibility, but not enough in my book. So let's go down, if you wouldn't mind, to slide 11, just a couple slides down on the top portion. So this is why this is important. And I want you all to look at the non-bank origination share for loans. For all loans, obviously, it's 86% for Ginnie. For all loans, though, it's 53%. And everybody thinks it's just the Ginnie program, but if you look at Freddie, Fannie, you're looking at 70% of 70% of all loans. If you look at Freddie, Fannie, you're looking 65% of Fannie, and then 53% of Freddie are non-bank. So the majority of loans being created for all the government guaranteed programs are non-bank. This isn't just a Ginnie Mae issue. And I would encourage you all to think about weighting, because Freddie, Fannie collectively do about double what Ginnie does on its own. Even though it's a smaller percentage, it's a whole lot of volume that's sticking out there that's causing a lot of pressure to the servicing market. If we could go to 17, and I'll talk us through as we get there. I want to just have us think about credit for a minute. So, you know, all of this weaves itself together. I get there are folks on this call listening who have had concerns or maybe have expressed concerns about the non-bank market. I think that's a debate that continues, and it's around the model, capital, stress testing, and more that have been going on for the past several years. My view right now is that this is causing great stress on the market. Lori showed some good data about what would and would not qualify now under current guidelines. And while not all overlays are at, you know, 700 with 20% down. By the way, that I think that particular investor has also, if you're self-employed, you have to have 12 months reserves. They're not all at that level. We are clearly seeing more overlays come on, not just simply because of uncertainty around what ultimate performance is going to be and take up on forbearance. I think there's also concern now that since the director has said publicly that he'd be comfortable letting some non-banks fail, you need to think about what warehouse lenders are thinking. So a warehouse lender, those are the guys who provide liquidity to non-banks so you can fund your mortgage. So an independent mortgage banker packages a loan according to agency or Ginnie standards, FHA, VA, USDA standards. They collect all the paperwork documentation, they get it to the closing table, and they fund the mortgage, but they fund it typically with monies from a warehouse line, and that loan gets parked on a warehouse lender's balance sheet. If that non-bank servicer were to fail with a pipeline of loans held on the warehouse line, ultimately disposition of those loans is going to fall on the warehouse lender. And so if you're a warehouse lender, the last thing you want to be stuck with is caught holding the bag, as it were. And so that's why you would begin to put FICO overlays and LTV haircuts, days online haircuts with penalties, in order to make sure that these guys are clearing their lines and that the credit quality is good enough that if the non-bank were to fail because they can't make advances, if they have a servicing, if they're a servicer as well, that they're not caught holding the bag with loans that they would ultimately not be able to sell at par or better. So why that's important, look at FICO scores here for a minute. And I want you just to think about what's happening in the credit tightness. So non-bank median FICOs are 737. Right, that means like half or below that. But if you scroll down deeper into the programs themselves, you end up with an even more specific story about where the needs are. So if we could just go to slide 23. And actually, let's start there for 1 second. This is first-time home buyer share. And as you can see, FHA makes up 82% of all first-time home buyers. This is critically important because what was really hot in the marketplace across the country was entry-level first-time home buyers and the first-round move-up market. If you live in Greenwich, Connecticut, there are for sale signs sitting on homes all over Greenwich because the McMansions are not appreciating and they're not selling as quickly. Where the hot market was appealing to this millennial cohort, which is live now and actually out in the market buying. And there could be restrictions as we see ourselves coming out of this if we don't get the credit environment back to where it needs to be. Obviously, that's going to be a matter of getting better confidence about ultimate forbearance, take up, the duration of that, as well as ultimate default and severity. But beyond that is also the credit tightening that's happening simply because the FHFA and the GSEs are out there making public comments about their willingness to let non-banks fail and not willing to back up as a federal regulator and as two companies that are essentially owned by the federal government, since the Treasury owns the vast majority of those companies in conservatorship, to be used as tools to help get us through this period. This is not a matter of, the GSEs providing a bailout as private companies. This is a matter of a national pandemic and a national crisis that is causing an incredible credit constriction because of a piece of legislation that thrusts a massive liquidity and capital demand on servicers and originators across the country. Originators for their ability to sell first payment forbearance loans to the GSEs, which is another policy announced yesterday, and servicers, now a majority of which are non-bank, given the market shares that we're seeing, that are having to sell having to do these massive advances in an absolutely unforeseen way. Could we go to the bottom section of that page? So this is important because if you look at first-time home buyers, remember 80% of all FHAs, first-time home buyers have an FHA loan. You can see the average credit score for an FHA first-time home buyer is 673. So the moment you put a 700 FICO score in, you're knocking out a massive chunk of the first-time home buyers, and unfortunately, heavily concentrated with minority buyers. So, you know, under the kind, if you were to do a demographic breakdown on the 700 plus 20% down kind of profile that one large bank lender has put out there, you're really looking at someone who's going to be relying on intergenerational wealth, money from mom and dad to get a 20% down payment, or as a move-up buyer, or already a fairly well-set career-wise in terms of savings and reserves to be able to come up with a down payment of that size. And the thing I would just highlight to you, when you look at the loan rate at the bottom of that same slide, you'll see that the first-time homebuyer loan rate at FHA is as good as it is for the GSEs. And a lot of that has to do with loan level price adjusters on the GSEs and how that impacts ultimate rate. But it's just an interesting component that's a really important program. Unfortunately, as we constrain credit based on this volatility in terms of federal policy during this crisis, the question for me is, how do we use housing as one of the engines to get us out of this thing? I'm almost there. Let's go to page 29 to the top. So, you know, this is what I know everybody's expecting to see, and you're seeing it in the forbearance take-up numbers. FHA does have a higher stress book, right? And we know that's part of the structure of that portfolio. And so we're seeing a lot more forbearance in the FHA program. I would say the good news is that's going to put the stress ultimately more on the FHA itself. And we'll see what ultimate recovery rates are. There's a slide in the PDF deck around single family inventory. And the inventory of single family homes is at record lows. This is very different than the 2008 housing finance crisis, which was built on extraordinarily weak credit, but also terrible demographics. And so we were actually losing owner-occupied households on an annualized basis, 7, 8, 9, and 10. And the growth was all of the household formation growth was in rental housing. The last 2 years in the United States, we've been creating over 1 million new owner-occupied households. It's an indication that the millennials are going out buying, or just put it in your own perspective. In 07 and 08, my home with my 4 kids, we were a household of 1. My kids were in college or living at home trying to get their career started. Today, there are 5 households in my family. My oldest has already bought her second home and is growing her family. So that demographic is shifting, and that's why there's a shortage of supply, available inventory. That's why generally, while we may see high delinquency, I'm not sure we'll see the severity rates. And so I'll leave it to the economists on this call to think about that. But the expectation is that there's sort of a natural floor to what happens to entry-level single-family housing. That may be different for some of the McMansion stuff where days on market we're already extending, but it's something to consider. So let's go to the last slide I'm going to talk about, which is slide 33. And if we could go down. Yeah, that's good. So this is a great slide that Urban puts together, and it really shows the trade away of when a GSE loan really isn't even competitive for first-time home buyers. And I just think it's interesting for us to keep watching, depending what happens as we go forward in terms of mortgage rates. Because as people pull back from bidding on agency MSRs, mortgage servicing rights, or put other overlays on GSE loans, because now I have a new cost burden potentially, either with a first payment forbearance loan, I want to talk about that in just a moment, or because of the cost of advances for forbearance to the GSEs, because they didn't create a functioning liquidity advance facility for agency loans. The likelihood is that these overlays will go up. But even right now, what this chart shows you is that if you're 720 FICO score or above, generally best execution is going to Freddie, Fannie. Below that, it becomes to be, it's more of a savings to use an FHA loan. This is because FHA flat prices the market. Everybody gets the same rate, no matter of your credit quality. For the GSEs, they do risk-based pricing. They use what's called loan level price adjusters. It's a grid that charges more based on your FICO and LTV relationship. And my concern here is that right now, there are people running from agency business. I had one investor email me yesterday. He said, the GSE, I'm done with the GSE business. I'm only buying Ginnies. And by the way, in my 30 years in the business, it's always been the opposite. You always put higher reserves on a Ginnie loan because the likelihood of default was higher. In this case, it's the uncertainty around these two elements. So I'll end with this, Lori, and then stop. And I know I've exceeded my time here, but the thing that's most unique to me is you can't go fixing or calling out the possible, your willingness to let non-banks fail when they're such a dominant part of the market. You can look in the rearview mirror and say, how did we get here? That's fine. But don't change the rules in the midst of a national pandemic and national crisis, because what we're seeing now is an extraordinary stress burden because of a thing called the CARES Act being thrust on the private sector, because all it did is say consumers don't have to pay their mortgage, but you guys still have to make your advances to the investor. And two extraordinarily important tools for the federal government, which is I think why we created them, to create market stability. Freddie and Fannie are being expressly limited in how they could step in. And I'll end with this. They own the servicing. Freddie, Fannie owns all the servicing. These non-bank servicers service on behalf of Fannie and Freddie. And so, you know, the thing that just dumbfounds me is if you're willing to let a non-bank servicer fail, it's Freddie and Fannie's responsibility to place it. And Mark sort of talked about, he even said in an interview, Mark Calabria, that they could place it somewhere else, and he even suggested the borrower might get a better treatment by being transferred to a bigger servicer. Something I think is not backed by anything other than fiction necessarily. But the point here is, if you're going to transfer a servicing balance sheet, it's being transferred most likely because there's a high number of forbearance loans in there. That's what took the non-bank down, because of the liquidity advances. And so what servicer in their right mind is going to be able to be willing to take up that servicing portfolio without huge incentives, significant discounts, and probably some form of capital to hire the staff needed to handle not just the forbearances as they're coming in, but to handle the workouts once they finish their forbearance period, which is where the real heavyweight lifting is going to come. So, you know, my clear bias here is that I understand the long-term objectives of the director and the GSEs. This is a short-term crisis that was unbeknownst to anybody in the United States, and it's creating credit contraction. It's threatening the non-bank industry because of even 4 months of liquidity. If we get up into the teens or close to 20% of forbearance advances, that depends on what happens with all this employment data and more going forward, is going to be an extraordinary amount of liquidity advanced out with not certainty as to when that's going to get repaid. And then the policy yesterday that if a loan goes into forbearance before you're able to sell it, that you can sell it with a 700 basis point haircut, unless it's a first-time home buyer, but all other loans, you can sell it with the 700 basis point haircut, or not to be able to sell it at all if it's cash out refi, is just outrageous, because you're now going to, as an originator, going to have to compensate for that. And a lot of people will tell me, well, we sell most of our loans in that before the first payment's made. We've already sold the loan, but many in the correspondent channel are still packaging and selling to an investor by the time the investor gets it, and then can sell it off to one of the GSEs. there are loans at risk. So if you can't clear your pipeline because of trailing doc issues or just time delay between the correspondent lender who's selling you that mortgage, you're creating a risk here that somehow has to be modified for or adjusted for in your pricing to compensate you in the event, because 700 basis points on one loan is about the total profit of multiple transactions that are originated by a lender today. So this to me is where the risk is. It's the excessive credit contraction above and beyond what you would normally expect at a time like this, simply because the CARES Act created an environment where loans are considered current, even in forbearance, which keeps them in their pools, which puts extension risk on all this for forbearance advances, and makes this policy of not being able to sell what were manufactured as agency eligible loans that are sitting in pipelines now that potentially cannot even be sold, even though they met all the other guidelines. So I think that's the policy piece that you're seeing a lot of the angst around. The articles the last couple of days, statements by the CEO of the MBA, and more. And so anyway, I think this gives a lot of help to showing what may happen here if we see the credit contract too much. Sorry for going so long.
No, that was great, Dave. That was really great. Thank you very much. Your insights are very, very much appreciated. And that's actually a perfect lead in to the questions we have. We're running a little bit long, so we're going to try to answer these questions relatively quickly. And then I'm going to talk about recent work and what's coming. I know some of you are going to have to drop at 11, and that's okay. But I do want to talk about answer the questions first. So the first question, which is really the nuts of the issue, is what's the expected linkage of unemployment claims, the unemployment rate, the forbearance uptake, and mortgage defaults? Most of us have keyed our estimates on advances off of the unemployment rate, but what we actually see is unemployment claims, and people can submit an unemployment claim, collect unemployment for a little while, and then later be rehired. So not every unemployment claim is a rise in the unemployment rate. So let me just tell you what our initial set of numbers were, and actually they're turning out to be slightly low. And I'll tell you our revised set of numbers. So we actually thought that the peak unemployment rate, based on economist projections, would be around 15%. If you get a 15% peak unemployment rate, that translates into homeowners at around 12% and renters at about 20%, because renters always have a higher unemployment rate. They're more vulnerable, and they're more heavily weighted toward the industries that are the most affected. If homeowners have a 12% unemployment rate, that translates into GSE forbearance of around 9% and Ginnie at around 18%. And obviously within the GSEs, it's going to be higher for higher LTV loans, but for the entire book of business, we were estimating 9%. And as a worst case, we were double that. In fact, the peak unemployment rate looks like it may be closer to 20% than 15%, which would basically knock our estimates up by about a third, but well lower than our worst case. But then the critical question is, how does the unemployment rate translate into forbearance? For many lower income households, that extra $600 in unemployment benefits for the first 6 months actually makes them better off. That is, the base unemployment benefits plus the extra $600 makes them better off, more than replaces their income. That's true for the median renter. The break even turns out to be about the 25th percentile of homeowners with a mortgage. So many lower income households actually aren't going to have a loss of income. So therefore they shouldn't need forbearance. But on the other hand, it's relatively so you can argue that for the forbearance rate should be lower than the unemployment rate because of that, although that only lasts for 4 months. On the other hand, you can argue that it should be higher because it's fairly easy to get forbearance. You state you have a hardship and you can get forbearance, and therefore there are a lot of people who will worry about being unemployed or have lost some income and they need to get forbearance, which is not going to be measured in the unemployment numbers. So I think the link between the unemployment rate and forbearance is extremely unclear. And then then what's the link between that and mortgage defaults? I think the the forbearance to loss, forbearance to delinquency and delinquency to loss rate is going to be much, much lower than for non-forbearance loans. You usually have about a 60 to 70% once you go 90 days delinquent to actually have some sort of a claim. For forbearance loans, it's going to be much, much lower. In disaster loans, it generally is, and this is meant, and for many homeowners, this is going to be temporary. So I think it's very hard to quantify at this point, but those were our numbers. If I were going to guess right now, our numbers are about a third low that we're going to, that the peak unemployment rate is going to be closer to 20% than 15%. Our estimates are all low by about a third. So with that, let me actually, second question goes to Karan, the need for a credit facility for mortgage servicers.
Thank you, Lori. So obviously, Dave just talked about this at quite a length in terms of, the importance of a liquidity facility for mortgage servicing. I sort of, break the issue into two parts. One is the immediate issue of avoiding large-scale insolvencies in the servicing market that causes turmoil, not just to the servicers themselves, but by extension to the consumers as well, who at this point are more dependent on their servicers to get the assistance more than ever. So imagine if you are a borrower and you just lost your job and you're calling up your servicer to request forbearance or mortgage assistance, only to find out that the servicer is no longer in business. So, there is a very, very strong consumer aspect to this as well. So, you certainly don't want consumers to be confused at this time to find out that the servicer is no longer in business, or the fact that their servicing was transferred to another servicer, which we know very well from the last crisis had its own share of huge problems where, during the transfer process, a lot of, documentation were lost. There was data that was lost that led to improper foreclosures, wrongfully denied loan modifications, and ultimately borrower distress, and ultimately larger losses for the entity that was on the hook for credit losses. So certainly there is that aspect to it. And then, the other reason for having the facility is more longer term, which is that, again, Dave alluded to this, is the fact that, most of the servicers that we're talking about are also loan originators, and they extend credit to the borrowers. So to the extent you had, some firms go out of business, that then has huge implications for access to credit for consumers. And we all know from the last crisis that access to credit never really recovered fully. So it continued to, it was a structural problem even before going into the COVID crisis. And it will be a structural issue that will be very difficult to bounce back from. So that's sort of the long-term issue with advances. But either way, whether you look at the long-term or the short-term, the need for this advancing facility has been critical, and Ginny obviously has announced the PTAP, and the FHFA also announced made the announcement on the form on capping the advancing at 4 months for their services. So those things will definitely help, but there is important consumer considerations for both short and the long run in this.
Thank you. And actually, well, I'm going to ask you your next question as well, and that is based on our numbers. Can Fannie and how long can Fannie and Freddie continue sending P&I to investors but not receiving anything from forborne loans before tapping out their lines at Treasury?
Yes. So this one is actually. So again, Lori, you briefly talked about our numbers for forbearance. So again, these numbers are a little bit lower. Like Lori said, they'll actually be 1/3 higher if you were to take into the latest unemployment projections. So basically what we estimated is based on the 18% take-up rate for GSEs in the worst case, that translates to about $6 to $7 billion of advances per month in terms of P&I payments for the GSE portion of the market. If you assume that every single of these borrowers would need this advances, would be on forbearance for the entire period of the 12 months, which is the maximum allowed under CARES Act, that translates to about $75 billion over the 12-month period. Now, At the end of 2019, Fannie Mae had about $114 billion in remaining Treasury funding commitment. Freddie Mac had around $140 billion. So in total, combined, well over $250 billion, which is well in excess of our $75 billion estimate. And even if you were to increase our $75 billion estimate by a third, or even if you were to double it, you still have a lot of Treasury funding commitment left over. So it is, by these estimates, it seems it will be very unlikely that the GSEs will need a Treasury draw just to cover the forbearances.
Thank you. And then, this question is for Michael, and then Sarah chime in behind him. How will the crisis affect housing credit availability? And does this how will this crisis affect housing availability? And does this crisis push people? Does this crisis push people out of cities?
Yeah, thanks, Lori. That's a really good question, and I think about it kind of in two ways. I think about kind of what's going on the existing side, and then kind of some of the things on the new side. On the existing side, I think that there is an expectation that inventory will fall, and people will remain in their homes and continue to weather this crisis. And that is probably increasingly the case, given the implied decline in demand from what we saw in the collapse in purchase mortgage applications. That being said, though, there was actually some modest increases in inventory over the end of last year and the first few months of this year. But what realtors have been saying overall is that they are literally experiencing fewer sellers wanting to list their homes in response to COVID-19, and so that suggests that we would expect inventory to track back downward in the ensuing months. I think Dave brought up an important point that this time is different in terms of inventory. We had roughly north of 3 million homes in inventory at the end in 2007, going into the financial crisis, and this time we have fewer than 1.8 million. So fewer than half new and existing homes are actually in inventory today relative to where we were at the beginning of the Great Recession. On the new side, there are certainly areas where residential construction remains essential, and so those are certainly areas where some building continues to take place. That being said, there is some real concern that status will be taken away as policymakers, as state and local policymakers see, unfortunately, people dying. And so that's a real concern for that industry. We have seen single family starts decline. They actually got past 1 million, the 1 million mark for the first time in a number of years, but then we see decline by about 12% in the most recent month, which is consistent with builder expectations. That being said, though, one of the additional concerns on the new side is whether or not a lot of those smaller builders will actually be able to weather the storm, and what that means for the market overall. A lot of them were running razor thin margins going into this, and any decline in activity could really hurt them, particularly given the fact that lending standards are not just tightening in the mortgage market, but they're tightening across the spectrum, including in the residential market, where there largely is no government as a backstop and to put downward pressure on rates. I think all that feeds into kind of the wild card, which is the direction of prices. And the story again is different this time in the sense that inventory is just low. So I will just jump in there in case that's an implied question, And I think number one, inventory is certainly lower than what it was going into the Great Recession, which has ramifications for prices, number one. But number two, when you start to see declines in demand and declines in supply, that suggests that the market is there's just less activity going on in the housing market more generally. And that has implications for the way that we actually calculate house prices. And so I think that that's going to be an interesting story going forward if we actually see some kind of freezing in the housing market. And then the final thing I'll answer your second question is an important one. It's certainly a question that I've heard a number of times, probably 3 or 4 times in the last month now. And I think that there is some belief out there that we will see a shift away from the urban core and moving out to the suburbs, partly or largely in part as people now realize that they might need a little bit more space in case this happens again. And so now they need to incorporate the need for an office or the ability to actually set up an office space in their home, which pushes them out to the higher, to the suburbs where there's more space as well as lower per square footage prices. That being said, though, I do want to also point out that number one, we had been seeing that kind of trend generally before this actually hit. Number one, but number two, it's also running up against a decline in the size of households. And so this really might be and it's too soon to tell, but this could be something on the margin where a couple with a kid might decide that they might forego the 2-bedroom condo in the city and instead decide to go to the 3-bedroom house out in the suburbs. But again, it's still too soon to tell. And I'll just leave it at that.
Sarah, do you want to add anything, or are you good?
The only thing I would add is on the credit availability side, just that we don't really have good data yet, and we'll know more next month. So just keep checking back the chart books, and we'll be able to monitor all our usual indicators going forward.
And thank you. And then we also got a question: what is the product mix for the Urban Institute's Housing Credit Availability Index for the Hakai? So can you answer that, Sarah?
Yeah, so when we calculate the Hakai, we divide loans into risky products and not risky products. And risky products are any products with prepayment penalties, balloon terms, interest-only terms, negative amortization, or ARMs with a reset period of less than 5 years. And so all the other like fixed-year, 30-year mortgages are all considered non-risky products.
Thank you. We had actually gotten 2 more questions, one on the Ginnie Mae, Fannie Mae, and Freddie Mac challenges during COVID-19. I think we actually did a pretty good job covering that during the course of the call. So if you need more details on anything, email us, but I think we did a pretty good job of covering it. And then the second question is, do you anticipate getting more granular forbearance numbers? And I think the answer to that is we would love more granular forbearance numbers. We're not in a position to generate them ourselves. So we welcome anyone who can and would love to be a user of your numbers. So with that, let me just finish up with sort of some of the work we've done and some of our upcoming work. Since our January call, we've hosted 2 events: a data talk about institutional investors' impact on the housing market, and our first virtual data talk this past Tuesday on housing supply challenges and solutions. You can watch recordings of both events on the Housing Finance Policy Center landing page. Since our last call, we've also published 6 research briefs, 3 of which were published in the last 3 weeks and are COVID related. The impact of COVID-19 on mortgage refinancings, avoiding a COVID-19 disaster for renters in the housing market, a liquidity vehicle for mortgage servicing advances is in the consumer's best interest, the Community Reinvestment Act, which was the comment letter to the OCC and FDIC, the potential and limits of Black-owned banks, and the termination of LIBOR, an update on the implications for the mortgage market. We've also published 15 blogs. Before the COVID-19 crisis, we were heavily focused on digging into the details of the racial homeownership gap. We'd looked at racial differences in reverse mortgage use, the impact of military service, college education, and parental wealth on homeownership, and offered insights into the data on homeownership. We also wrote about how ADUs could help with the housing supply crisis and how institutional investors impacted the housing recovery. Since the COVID-19 crisis, we've published 6 blogs that elevate the need to help renters, particularly those who are the most vulnerable, quantify the billions of dollars that will be needed to support renters and homeowners, explain the gaps in the tools we have to help homeowners, and talk about the way the crisis is impacting access to credit. All of these are available on our Housing Finance Policy Center landing pages. In upcoming weeks, we'll be releasing a very interesting pre-COVID-19 paper about housing price tiers, that is housing prices by price tier, as well as a comment letter about home loan bank membership for non-banks and REITs. We'll continue to blog and release data and analysis that are useful to policymakers during the COVID-19 policy crisis response. Finally, mark your calendars now and plan to join us on our next virtual data talk on May 6th from 11 until 12:30 with a panel of experts who will discuss what's next for the Community Reinvestment Act. I'll be joined by Buzz Roberts, President and CEO of the National Association of Affordable Housing Lenders, Josh Silver, a Senior Advisor for the National Community Reinvestment Coalition, Mark Willis, a Senior Policy Advisor at NYU Furman Center, and moderated by Ellen Seidman, a non-resident fellow at the Urban Institute. So with that, thank you all very much for joining our data talk call, our Chartbook call today. We really appreciate your interest and we look forward to seeing you at the next call next quarter. And a special thanks to Dave for being our special guest today. So thank you all very much for joining and take care.